decision making, and the economy has been awkward at best. We'll probably hear a little bit more about that, but it's still a great time to, this might be the best year of all time. You know, realtors always ask a realtor, what's the best time to buy real estate?
Right now.
And the answer is now. But in this particular year, that could be the accurate case with low rates and prices at a bottom. So I think we have a compelling argument to make. But we're going to start off here. We're going to go in order on your agenda here, if you will. We're going to go with Mark Bendner, and then Joel's going to speak to us, and then Jerry Habib is going to speak to us. And you know, Mark's got a wonderful view of the national economy that we don't normally hear. Joel Singer is 24 years CEO of California Association of Realtors. He knows California like the back of his hand. He's in touch with all of the office owners statewide, so you're going to get a perspective from him you can't get anywhere else. And Barry Habib had his own finance company. He's a chief strategist for RPM Mortgage. He appears on TV nationally, and you know, we're just fortunate to have these people this morning. Let me say one little note here. If you need to leave, if you could leave by the side entrance, it'd be less disruptive. And number two, if you have a question for these gentlemen, you've got a 3x5 card there in front of you. So we're going to ask you to write down your questions, and we'll collect those cards, and then we'll ask these penetrating questions that you've thought out after they conclude their remarks. Okay? And with that being said, I think we're going to kick off with Mark. You're going to tell us your view of how things look. Sure, whatever you'd like.
Good morning. Hopefully everybody can see the slides, and you don't have to read the numbers that are on them. I know the back of those numbers look kind of small, but you can see the direction. And I'm going to go through it kind of quick and try to keep the anecdotes to a minimum, but I always get carried away with them. But in terms of the U.S. economic outlook, things have been looking a little bit better. We got the employment number on Friday, which really got everybody all excited, and the employment numbers have looked a little bit better over the last few months. But I continue to stress to people to try to keep things in proportion. It seems that there's a tendency in the media right now to jump on any number and accentuate the positives. Yesterday, I got a call because at the airport there was a radio show, and I think it was Market Watch or something, and they're like, well, consumer borrowing's up $20 billion for the second month in a row. Isn't that a great thing that consumers have the confidence to go out and borrow? And I said, well, it may be. About 80% of the growth goes in student loans. I mean, it's not credit cards and car loans. And I said, you know, and I'm really wondering where those guys are going to school. The other question is, when I look at the data, even with the improved employment data, the mix of jobs has not been that great. 46% of the jobs have been added since we began adding jobs in March of 2010. That's when private sector growth started to pick back up. 46% of those jobs have been in either retailing, leisure and hospitality, temporary staffing, or home health care. And those are four of the lowest paying industries by the hour. It's 46%. I mean, they don't make up 46% of the employment base, so it's a disproportionate share of the growth that we've seen. And as a result, income growth has been very sluggish. And over the last year, real income has actually declined. You take the growth of income, you subtract out the inflation rate, and make adjustment for taxes. There haven't been any adjustments for taxes, but they have gone up, mainly at the state and local level. Then income is down. And maybe that's why people are borrowing more money, because we also had in January a spike in gasoline prices. So I'm not, I know economics is a dismal science, and I'm not trying to rain on the parade. Things are really getting better. They're just not getting as much better as people would think. When you look at overall economic growth, GDP is the value of of all final goods and services produced in the economy, we're still growing at around a 2% annual rate, which is totally inconsistent with the drop in the unemployment rate that we've seen over the last year. There's an old rule in economics, and I think they stopped teaching it about the time that I went to school way long ago, when Herschel Walker won the Heisman. But it's called Oken's Law, and it showed the relationship between GDP growth and the unemployment rate. And we looked at that relationship, kind of brought it off the shelf and looked at it. And when you do the regression, the growth that we've seen over the last year, which was 1.6% year to year in GDP growth, with a 0.9 percentage point drop in the unemployment rate, was almost 1.5 standard deviations away from the predicted result. I mean, it was the widest gap between the relationship between GDP and the unemployment rate ever seen. Something's fishy with that drop in the unemployment rate. And what we think is going to happen, what we think has happened, is that because of how deep the recession was 2.5 times deeper than a typical recession, it is distorting some of the seasonal adjustment factors. And that normally in October, November, December, hiring picks up. But because it fell so much more in October, November, and December of 2008, the seasonal adjustment process is expecting less improvement than normally occurs, and that shows up as stronger job growth. It also shows up as a drop in the unemployment rate. This is something that has been apparent in each of the last 2 years. And what's happened is that at the start of the year, everyone says, oh wow, things are getting better, layoffs have slowed, hiring's picked up. And it has been doing that all throughout the recovery. That's why it's a recovery. But that ramp up in economic activity has been exaggerated, and then comes spring, somewhere around the middle of April or May, the numbers seem to fall out of bed. And it's like, wow, things are a lot weaker than they thought they were. And then by June or July, everybody starts talking about double dip again. And the pessimism, it gets as wildly exaggerated as the optimism did. And what we believe is going to happen is very modest economic growth this year. And as we get in the second half of the year, there's going to be some uncertainty surrounding the presidential election, and also a lot of uncertainty dealing with policy. The Bush-era tax cuts expire at the end of this year, and unless Congress can pass an extension that the president would sign, they're going to expire. If you do nothing, they expire. The new tax increases that go along with the healthcare reform law kick in on January 1st. And just looking at the taxes, the tax roll in here, it's a 3 percentage point swing in GDP. We're taking 3% of GDP out and reallocating it into tax revenue. There's also a lot of spending cuts that are set to take place. Remember the big fight they had last year that they couldn't get, the super committee couldn't agree on anything, so there's going to be a $1.2 trillion cut in spending over 10 years, which will begin in 2013, half of which is from defense and half is Medicare reimbursements. So when the Congressional Budget Office looks at 2013, they're forecasting, this forecast was last Wednesday, so it's fairly new, 1.1% growth. Now, we don't think that's going to happen. We're right around 2. But the point that I'm getting to is that it's far from certain that the economy is out of the woods. It's far from certain that we've broken up, or I think we're out of the woods. It's far from certain that we've shifted into higher gear. And there's still a lot of uncertainty out there in the near-term horizon. People always say, well, what do I do with that? I mean, what do I do with that in my business? And what I tell people is be prepared that when there's that optimism, when there's that liquidity in the markets, be prepared to do as much business as you can, as quickly as you can, because things are going to change relatively quickly. Now, one of the biggest sources of uncertainty, and I'm glad I brought my charts with me because I forgot to mention it, is Europe. And I could go on and on about Europe, and I won't. All I'll tell you is that the situation there is worse, far worse than most people realize. And that anytime you hear any good news about Europe, that's going to be one of those times where liquidity is going to come back to the market, people are going to feel better about things. But you can also just take it from me, it really isn't good news. They haven't solved it. Since the European debt crisis came up in April of 2010, I guess, or maybe it was 2000, April 2010, when it really came to the fore, we had big riots in Greece. We are not 1 inch closer to solving the sovereign debt issue here, not 1 inch. And we haven't made any progress at all. And the situation has gotten much, much worse. I'm not certain that it can be fixed. I'm not certain that Greece, Italy, Spain, Portugal, and Ireland can be fixed. When I say that, I'm not certain that the mathematics will ever allow it. I often tell people, I said, you know, what, if they want to come up with all the plans that they have, that they come up with, lead to these riots in the streets, and there's nobody in Greece that's really for the plan. And I said, well, it makes perfect sense, because what they're asking the Greeks to do is to work like Germans and pay taxes like Swedes. And they're Greeks, that's not what they're doing. The big problem is Italy. Where I said people don't realize how bad things are there, is that Italy is one of the largest economies in the world. They have the 3rd largest amount of sovereign debt issued of any country in the world. You can see Italy's on the far right, Greece is kind of in the middle, and you've got Ireland and Portugal at the far left. And most of that debt's held by banks in Europe. And so if you were to see a disorderly default in Greece, it would quickly lead to a liquidity event around the world, and it would get tougher to borrow money. And that's really the bottom line. And that's why I said, when there's these bits of good news, encourage people to close as quick as possible. Encourage people. And when people tell you, wait a minute, Bernanke said that the Fed's going to keep rates unchanged till 2014, that's not what he said. He didn't say that. The Fed's not going to keep rates unchanged until middle of 2014. What they did is they said, if you looked at where most of the Fed's forecasters, and there's 19 of them, said when will the first rate hike occur, more of them said the middle of 2014 than said anything else. But a 1/3 of them said it would occur earlier than that. And it's a moving target. It will change at every Fed meeting 10 times a year. It will change 10 times a year. And I got to believe it's going to come at the first meeting sooner rather than later. So just be aware of that constant uncertainty. One of the things that's most encouraging to me is that job growth, not only has job growth picked up, and it legitimately has, even taking into account the seasonal adjustment factors, but it's occurring across a broader segment of the country. We're seeing that most areas of the country are now seeing job gains. And one area that's really evident is hard-hit Michigan, which is down there at the bottom. And you can see how job growth has come back there. You can see in Florida, you can see Arizona and Nevada. Nevada is a real recent event. Only within the last 30 months have things begun to pick up in Nevada. And then, of course, at the top is the energy states. California is somewhere there in the middle, growing right about the same rate as the rest of the country. Now, in terms of housing, and I'll get to California more specifically in a second, in terms of the housing market, we've seen a lot of optimism about housing, about how the recovery is starting in housing. And we've got a ways to go. We've got a long ways to go. Things are clearly getting better, but because the weather has been unseasonably mild, particularly in the Northeast, the numbers on housing starts and home sales have been exaggerated. Back in November, when, and the data's probably changed since then, but back in November it was unseasonably warm in the Northeast. Very little home construction takes place in the Northeast because you can't pour concrete in the frozen tundra. But and in November it was warmer than usual, and housing starts on a not seasonally adjusted basis rose by 500 units in the Northeast. They don't build a lot of houses in the Northeast. When they seasonally adjusted the data, because they normally fall that month, it turned into a 28,000 unit increase, and housing starts for the nation only increased by 17,000 units. So, you know, it was exaggerated by the weather. I know most of the nation's major home builders, and they are still in survival mode. We thank them all. They are doing more, because if you're a big home builder and you've got a brand name, you want to protect the brand. You want to stay out there. And what they're doing is they're buying lots where they're inexpensive and residential developments that have been partially built out. And they're building homes that can compete with foreclosures because they're closer to the job market than many of the foreclosures are. And it's really good product, really good price. But it's limited. There's a small number of them because they don't have much margin in those homes. We're also seeing some infill development pick up, and it's because the land prices have come down. But in terms of a longer-term recovery in home building, that's not going to happen until we answer the questions about shadow inventory. How much of it's out there? I happen to believe that there's not as much shadow inventory out there as as some of the more crazier forecasts, which come up there at the 6 to 8 million units. We use the First American CoreLogic number, which is, I think, 1.6 million units. It's still a lot. And a lot of those units are in places that people do not necessarily want to live. So it's going to take a long time to get rid of it. But because we don't know for certain how much is out there, appraisals are very conservative. And those conservative appraisals mean that about a third of all contracts fail at closing because the appraisal comes in below the transaction price or the agreed transaction price. So the buyer has to either come up with a bigger down payment or the seller has to cut the price and it doesn't do it. And mortgage underwriting is also very tight because lenders are worried that values are falling. And that's really set by Fannie Mae and Freddie Mac. It's not set by the lender. Well, a couple of things are going to happen this year that I think are going to help clear up some of the shadow inventory questions. Fannie Mae and Freddie Mac are going to sell a lot of their inventory this year to folks that intend to rent it. That doesn't remove the shadow inventory. Because I've looked at some of the prospectuses of the folks that are raising money to buy these properties and rent them. And their plan is to sell those homes in 5 years, not to other people that want to rent them, but to sell them. So it just removes it from shadow inventory today and places it 5 years down the road. But it'll also, what it will do for us is it'll show us where those homes are. And my hunch is, by looking at the data, we get a lot of data ourselves, that a lot of these rental communities will compete with Class B and Class C apartments. And people are going to realize, wow, a lot of that shadow inventory is a lot more concentrated in markets, in markets that in a handful of markets than I thought it was. And so I think that people, as we move along those lines, we'll begin to see that the shadow inventory problem is not as big a problem, is not as big and as universal a problem as it's widely believed. And I think appraisals will begin to normalize over the course of the year, and we'll see that the number of failed transactions comes down. So I do see us making a little bit of progress in that. But we're not going to get a full recovery of home building until we figure out, until we move past some of the shadow inventory questions, and also figure out what the government's role in mortgage finance is going to be. Ultimately, Fannie Mae and Freddie Mac are going to be wound down. Now, it's not going to happen next year, but they're going to be wound down. And parts of their business are going to be sold to the private sector, and there may be new enterprises that are sprung out of them. But there is no plan to keep them running as is. It's very hard, and Fannie and Freddie had an implied guarantee by the U.S. Treasury for a long time. It worked kind of well. But then when they got into trouble, that implied guarantee got hardened and became an actual guarantee by the U.S. Treasury. It's very hard to go back the other way and say, well, we're not going to bail them out. That's not going to happen. So they're going to have to be wound down. Well, that's a big problem in terms of getting the private sector all pulled up about residential development. And I don't think we're going to get a strong recovery until we move past that. And that's probably 2014, 2015. Now, looking at California, you can see how far we fell in this recession. By far the worst recession that we've ever seen in the post-war period or the modern era for California. About twice as deep as the one we saw in the late 80s. And we've made a little bit of progress. I mean, we've seen a fairly strong recovery in the last year in terms of job growth. The unemployment rate has come down, still very high, 11.1% in December. Most of that drop in the unemployment rate, though, has come from folks dropping out of the workforce. In the last part of last year, it may be due to some seasonals, we did see an increase in employment, which is the bottom part of that chart. So we did see an increase in employment as measured by the household employment measurement. When you look at where unemployment is the lowest and where it's the highest, it's the lowest pretty much along the coast. The coastal areas are improving ahead of the interior. That's no surprise, and it's the highest in areas where home building was most overbuilt, which is mainly the Central Valley. In terms of home prices, they're still coming down. This is single-family home prices are still coming down. They're falling roughly in line with the nation. We expect home prices to continue to drop to the middle of the year. But when you break it out, and I don't have it broken out here because I've limited the slides that I had, when you break it out by distressed sales and non-distressed sales, sales prices for non-distressed homes, both nationwide and California, are roughly flat where they were a year ago. What's happened is that a larger proportion of home sales coming down, a larger proportion of sales in the last 3 months have been distressed transactions, and that's brought down the index. Single-family developments continue to slide. California, we are seeing a pickup in apartment construction, just as we are in other parts of the country. And looking at the Los Angeles MSA, fairly strong job growth over the last year, better than 3%, and unemployment rate has come down. We're roughly in line with the nation, in line with the state, though, right around 11%. Same basic trends in housing, but a very strong bounce back in apartment construction that we're seeing in LA, just as we are in many other markets. The last chart that I have here shows you the, he was happy that it was the last chart. The number of homes with negative equity in California, which is right at just under 30% for the state's homes that have a mortgage in the state. If you don't have a mortgage, you can't be negative equity. Are a little more on that mortgage than the home is worth. In LA, it's 23%, and the nation is right about 23%. And looking at the shadow inventory, I believe Los Angeles is right at 10%. It's a little bit less than the U.S. average. And California has moved a little bit faster on foreclosures than some other parts of the country, specifically Florida, where I was just at last week. And I think there are more foreclosures in Dade County than there are in the entire state of California. But don't quote me on that stat, but I think there actually are, judging by the size of the legal paper, which is bigger than the Sunday in LA Times. I mean, it's really quite amazing. And I mentioned about apartments. This shows you what's happened to apartment demand. And it's the last thing that I wanted to mention here. There's a big belief out there that young people are now part of something called Generation Rent, because they rent, they rent their books, they rent their movies. Many of them just rent cars, through Zipcar or whatnot. And people believe that they're never going to buy. And I always say, well, unless they rent their spouses, which in parts of LA you do, I guess, and rent their kids. Eventually, they are going to get older and they are going to rent again. But what I think has happened is that in the last decade, those young people were rushed into condominium purchases, and now they're going back to renting like they normally did, because young people, they haven't quite decided. When you're in your 20s, you haven't quite decided where you want to live, where you want to work, what you want to do. And I never thought of buying a home until I was over 30. So I mean, it just didn't occur to me, because I knew that I wasn't that settled. And I think that's where a big part of the apartment demand has picked up. And the other thing that's picked up has been people. There was a slowdown in the rate of people moving out of apartments and moving into home ownership. And in the fourth quarter of last year, there's a survey that is done by the National Multifamily Housing Council that asks, when you don't renew your lease, why did you not renew your lease? And for the first time since the recession ended, it's further than that, the number of people that said that they were not renewing their lease because they were buying a home actually increased. So I don't believe that we've entered an era where people are not going to own homes again. I'm pretty certain that will never happen. I'm going to stop right here. Hopefully we're right on time, and we'll move on with the program. Thank you.
Okay, thank you, Mark. It was very informational, and got some new concepts I've never heard before. So now, if you are interested in that presentation, you want to study a little bit, just shoot us an email, jack.gillespie@southbaybrokers.com or sunny.manley@southbaybrokers.com will also work effectively. We'll send you a PDF of that. Now we're going to move on to, I think Joel's going to tell us what's going on in California, and I'm sure he's got some very perceptive things to say. So there's a build-up.
Good morning. It's nice to be here. First of all, you guys are very lucky. You get to live here. I had to drive from the valley, and I have my own index. I thought Mark did a great job with the, with the economic portions of this talk, and I tend to agree with much of what Mark said. But I have the Singer Index, and the Singer Index, and I used to be an economist, by the way, before I did this other job. The Singer Index is predicated on how long it takes me to drive from Tarzana to just west of downtown. The Singer Index is up 11 minutes since the bottom of the recession. Actually, I think the economic growth in California has accelerated, as you've seen. And I'll run some slides through as well. But one of the things I have to say before I do, it's really an honor and pleasure to be here. I actually remember when this company was founded, when Jack and Jim and Annette and Sonny and a couple of other people founded this company. The one thing that has always stunned me over the last 20 years is that this is, relatively speaking, a small company for Los Angeles, but you always show up in the top 20 because you are among the most productive agents in the entire county. So it's a pleasure and an honor to be here. And I also want to make one observation. Mark kind of hit on this too. Along with all the things that you have to do daily to survive, we're really in a very unique moment in terms of the real estate industry, and more important, in terms of the policy towards housing in the United States. For the first time, we're being questioned on whether or not homeownership is of value. I thought Mark's analysis on why people tilt towards rentals and administration is a pretty good one. But I think the real question is going to come, not only in terms of what our policy should be on housing, but how we're going to finance it. And I'm going to touch a little bit on that as well. So I'm going to run through a bunch of slides very quickly, and you've got them, so you'll make them available to you, or I can email them to you guys, whatever you want. But I'm going to run through quickly. If I do it fast enough, it'll look like a video. So I'll touch on the economy, I'll touch on the housing market. I'm going to do a little bit on the local market. I can't tell you what, you guys know the local market better than I do. But I can make a couple of observations, and I'll end with something of a forecast. But I also want to touch on those bigger picture issues. From an economic conditions, the consumer confidence level is up, obviously slightly, but remember, 100 is normal. And so we've got a long ways to go. People are very uncertain about the economy. They're very uncertain for good reasons. This is the most protracted downturn any of us have seen in California. It's protracted both from a real estate standpoint and from an economic standpoint. The unemployment rate, again, I don't want to rehash what you heard from Mark, but it's abysmally high. It's been a very slow improvement. I have a little theory along with seasonalization. I also think we underestimate in our statistics. I know we underestimate in our statistics what I call the squatter economy. If you're, if you haven't paid your mortgage for 2.5 years, or for that matter, if you're doing a lot of things off the books, I think that's a bigger portion of the economy. I think there's a lot more of a gray market, a lot more of a black market than we've seen before. And that, along with the squatter economy, kind of, to me, works the other way than the seasonalization. It actually understates some of the strength in the economy and explains why the Singer Index is going up while the economy is flat. The deficit, obviously, is the highest in decades. This is not atypical of downturns, but it's of another dimension, obviously. And the problem of trying to figure out what to do with correcting a deficit, while at the same time trying to grow an economy and trying to replicate that throughout the Western world and Europe, as Mark pointed out, makes this such a knife-edge, precarious situation. I think Mark's absolutely on target when he says you just have to be on your game. You just have to expect the unexpected. But by the same token, I'm a little more optimistic. The mortgage interest environment is very, very favorable. We had a signal that it's going to be favorable for a couple of years. The Fed hasn't called everything right, to say the least. So I'm not sure that we should say that you've got 2 years' time to move in this marketplace. But affordable interest rates and affordable housing prices, or prices that have really cratered, obviously, make this the most affordable market I've ever seen. And I'll just be very blunt. I think this is a once-in-a-generation buying opportunity. That for no other reason than the only way I can figure out the cataclysmic scenario that Mark and I were talking about. There's cataclysmic scenarios here. The only way out I can figure is you inflate. And if you inflate, that's going to be good for housing. And so from my standpoint, the urgency might not be there, and you've got some time, but I'm telling everyone I know, you can buy housing in many places for far less than replacement costs. A little different here because your housing values are so high, but in parts of the Redondo market, for sure, in parts of California, you're buying housing for prices below replacement cost, negative land values. From my standpoint, that's one of the safest investments you ever make. You're getting real return. You're not betting on appreciation in many parts of the country when you make a housing investment. Existing single-family home sales, obviously this is what's occurred. This is for the U.S. Not a very pretty picture. We're still seeing some increase year to year in 2011 after the depressed activity in 2010. A lot of that actually wasn't the seasonality, but it was the impact, kind of the rain shadow of the tax credit. And so we're also struggling with that when we look at the numbers. Our view of the economy is pretty dismal, quite frankly. We don't see a lot of growth. We're saying 2%. We're probably more conservative. What's your number for the economy? It's a little higher, probably.
It's 2.
It's 2 also. Okay, so again, we're concerned about the economy, but as I say, I think there's some reasons why it might be understated. From California, we're looking a little stronger. Job growth, we're looking stronger. We've already succeeded. We've gotten more favorable on our unemployment rate than our forecast. Population growth is still positive in California. Real disposable income growing at 2% is not where you make a booming economy, obviously. So we still have concerns on the economy. But again, I think there's all these downside risks, but there's also upside risks. This thing at some point, even if we don't believe it, after 4 or 5 months, it becomes sustainable. If you start doing 200,000 jobs nationally a month, and the California growth for the last 4 or 5 months, it starts sustaining itself. So I think there's reasons why, all I talk about are wild cards, and they're always downside wild cards. I think there's also upside wild cards in this forecast. Critical issues for us, from my standpoint, absolutely critical, future of Fannie and Freddie, and I'll show you why. Qualified residential mortgage, we'll talk a little bit about that. One of the other reasons to buy is you're never, it's not clear whether the 30-year mortgage is going to be available looking out 3, 5, 10 years. And that's another incredible incentive to buy. So from my standpoint, let's start with Fannie and Freddie. The ironic thing, I hadn't really thought about this until I was watching CNBC today. And the number they said for suspending the payroll tax for the 10 months of this year, you know how much that's going to cost? Even Mark doesn't know this. $140 billion. $140 billion. With all the dismal failure, everything that's gone wrong, all the incorrect subsidy economists tell us about that Fannie and Freddie have had, you know how much money they've lost over the last 5 or 6 years? The last number I saw was in the high 130s. So in other words, that subsidy of home ownership that supposedly occurs from Fannie and Freddie costs the same as 10 months of waiting the payroll tax. And to me, when I look at that and I ask myself, where should our dollars go? To me, it's a pretty easy answer. Home ownership has incredible value. Now, one of the things you see here in this chart is the scary part. At one point, we had a marketplace in California that was pretty much a non-Freddie marketplace. In this marketplace, for, I guess, 3 years, did you ever see a Freddie loan here between 2004 and 2007? Almost none. Almost none. But today, the problem is, and again, you guys don't see it as much as any place else, but the fact of the matter is right now, just looking at pure and simple, 90% of the market is Freddie, Fannie, and FHA. The highest numbers that I can remember, at least since the 70s. Take away Freddie Mac and Fannie Mae. If there's no private response, obviously there will be a private response. That's what you get. And it's pretty scary. And the question is, can the private sector jump in and how quickly? Because I agree with Mark, what you have to do is get rid of Fannie and Freddie, call them something else, make them disappear, and recreate them. Because the fact of the matter is, nobody's going to buy a private mortgage-backed security without a government guarantee. That market is dead. You're a German banker, and you even mentioned buying a private mortgage-backed security, you immediately get tried out and shot. The fact of the matter is that market is so poisoned, it's going to take 7 to 10 years at best, from my standpoint, for the private MBS to come back. And without that, we're really in a difficult shape. So when you hear these debates on Fannie and Freddie, it's very much in our interest to maintain them. And all bets are off if Fannie and Freddie were to disappear overnight. Now, obviously, I think Wells Fargo and the other private banks are going to be more portfolio lending. You're doing a fair amount of it now. But the fact of the matter is, even in this market where prices are falling, where sales activity is relatively low, the portfolio segment is virtually inconsequential. And to expect it to ramp up to replace the GSEs is ridiculous. Just on the QRM, I won't spend any time, but some of the regulations that were proposed, and I'll blame Wells Fargo for the worst comment in those, they wanted a 30% average down payment. By the way, Wells Fargo is also in our surveys that we do every 90 days, and I share them with Mark's executives. They have been the best short sale lender in California, by the way, to their credit. way better than some of the other names I won't mention. Wells Fargo suggested you need a 30% down payment. Even if the 20% that was pros in the initial regs, only 1 in 5 loans would meet the QRM test. So again, this whole notion of over-regulation that the banks are also concerned with, obviously, as they have to implement it, is dangerous to us. Let's turn to the housing market. You obviously are all survivors, and you have gone through the worst downturn ever. It's been the longest, the most protracted from the standpoint of realtor incomes, by far the steepest. We saw not quite the drop we saw in 80 to 82 in terms of sales activity, but it's lasted much longer. And if we look at the dollar volume, of sales, this is kind of relevant because this to me is gross realtor incomes. You can see what's happened for the state of California. Now the good news is they went up slightly in 2011. And our forecast suggests that they should be flat or slightly up in 2012 as well. So the drop in incomes that we've been seeing has finally ended, and it was an incredibly precipitous drop. It was more than a 50% drop in the average realtor earnings in the state of California. And so, again, I suspect you guys look much different. This firm has always outperformed, but the good news is it's stabilizing and starting to go up slowly but surely, and again, it depends on where we end up with the realities on these forecasts. This is a map of sales and consumer confidence in California. You know, we're now trending upwards again. Obviously, if you look at these numbers, we are trending upwards a little bit, but we're at around 500,000 units statewide. We have to do some adjustments in those numbers because of NAR adjustments as well. We have always adjusted to their numbers. The market is actually not that far off the long-term average. It's very, very close to the long-term average, actually. And we've been up in the last quarter, not unexpectedly. Median price, the price issues are still very pressing. We saw a 59% drop in the statewide median from peak. Obviously, you experienced nothing like that in this marketplace. And we've had some price stabilization since. Prices went up in 2009, and then we're fairly flat in 10 and have been down over the course of the last 12 months. But it varies, and it varies dramatically. Local markets are far more important. I'm going to touch on those. One of the other things to understand the California marketplace is, for a whole series of reasons, we're now seeing a record number of non-owner occupants. The vacation home, second home number stays consistent. I think the second home number, to a degree, may have changed a little bit. Some second homes were real second homes and are now investment homes. But if you look at the investment number, we're actually running at 17% of all sales in California. We're a high-cost market. We did not have, despite what people think, we did not have the flipping that you saw in many other parts of the country during the booms of 4, 5, or 6. We're up to 17% investment market. Now, the good news about that is investors help clear that inventory, both the current inventory, and will help clear the shadow inventory as well. The bad news is that you're not going to get that much of it. A lot of that's tapped out. So far, it's been small investors. Small investors can come in with cash. There's a lot of people putting together small cash syndications, and so there's even talk of larger cash involvement in the marketplace. I think, by the way, that would be stupid in California at the moment for reasons I'll talk to you about in a second. But the role of the investor is large. And one of the issues is, I don't know if you're running into it so much in this marketplace, but we run into, there's a cap of effectively 5 or 10 mortgages on the Fannie Freddie level. And that's also retarding that development. Foreign buyers, they're just not that big of a factor in the marketplace. I just want to hold that out. And what we define as a foreign buyer is somewhat unclear as well. But just as they're not insignificant, but they're a much more significant part of the Florida market and others than they are in California. And that number has been fairly flat. 2008 number was somewhat higher. Here's the real story. It's about unsold inventory. We're now down, for our February number, we're down to a 4.1 month supply statewide of inventory. 4.1 months is what normally? It's a seller's market. It's normally a seller's market. And the real way to look at this, and I've got some other slides, I didn't bring them, is to look at this with what Mark suggested. If we could do a monthly snapshot of what we thought the actual shadow inventory was, it would probably tell you the tail. But part of this also is, even with a 4.1 month supply of inventory, part of the tail is the difficult underwriting standards. The availability of capital, that 30% failure rate on transactions is extraordinarily high. And I'll just make the observation, when prices were 3 times, or in California's case, 6 times household earnings. There was no underwriting going on. You had to fog a mirror, and sometimes you didn't even have to fog the mirror. When your parking lot attendant, stated his income at $160,000 a year, and underwriting was effectively non-existent. Today, and again, I agree with Mark, Fannie and Freddie are really the principal problems here. Underwriting has gone the wrong way. It's become far too tight. There's 2 parts of underwriting. It's the credit side and it's the asset side. There's never enough attention from my standpoint looked at the asset side of underwriting, the actual intrinsic value of the property. And it's gone the wrong way, and that's impeding our market. The thing that's really impeding our marketplace, and we'll see it when we go local here in a second, is the inventory. Now, the inventory is radically different by price. If you're looking, we've got a median price in California now of around $300,000. Below the median, we have less than a 4-month supply. And it gets progressively higher. And these are down, by the way. They're down substantially from last year, especially at the $1 million level. Part of that is also price depreciation. But if you look at the $1 million inventory, it's twice the average inventory. And if you look at the bottom 25% of homes listed in every marketplace, those prices are constant or going up slightly. And that inventory is extremely low. So we have the anachronism, if you will, of $1 million homes are the most expensive 25%, which may be much less than $1 million in many markets, sitting on the marketplace, and we've got bidding wars at the low end. And I think that gets lost when you don't localize the markets, which we'll do. This is an important point that Mark made as well. Equity sales in December were 53% of our marketplace. During the worst part of the downturn, they were about 30% of the marketplace, a little less than 30% of the marketplace. And they're split fairly equally between REO and short sale in California. If you look at the seasonal trend, I apologize, these are PC slides that were converted to my Mac, and they're doing funny things. If you look at it from the standpoint of what's happened in terms of the share of sale, there's some seasonal factors occurring there, but basically we've been roughly 50% of the market as equity sales and 50% distressed sales for the period since the middle of 2010. We expect this actually to continue, but probably see the equity sale portions going up. And so if you've got sellers who are in a position to do an equity sale, they're going to face more competition, not less, moving forward. And if you've got sellers, particularly trading down, even with the inventory being somewhat high in the high end, it's a better time to sell than to wait. Okay, so we look at it in Southern California. I'll start to localize this. Los Angeles has got 48% of the market in short sales and REO sales. And you can see the REO numbers in Southern California, with the exception of Riverside, San Bernardino, where you had incredible amounts of new construction, are fairly low. Even in San Diego, surprisingly, that market has recovered very, very quickly and has the lowest percentage, at least in the last couple of months, of distressed sales. Now, here's the question. If you look at median home price, and you look at it per square foot, you look at it from every indicator, equity sales are far higher cost sales. Again, this is a statewide number, 1,800 square foot. The square footage price on an equity sale is twice what it is on an REO sale, and about 30% higher than what it is on a short sale. Short sales are total pains in the ass. And again, the only people who've done a good job, I have to say, was Wells Fargo with their portfolio of stuff in World Savings. That portfolio. The reason they did such a good job, I suspect, Mark, you can tell me if I'm wrong, is they had marked that portfolio to zero value, so any sale was a plus. But they did an incredible job with that. But short sales remain a pain in the butt. But short sales reflect very good value. And I know you guys are starting to look at short sales very seriously. The lenders are definitely getting better. Wells Fargo has a more difficult portfolio, but is certainly improving. All the lenders are improving. We survey this, I think many of you participate in our survey, every 3 months. They're all improving. But short sales represent very, very good value. And if you look at the sales to listing price ratios, and we try to get the original listing price here, you can see that these sales, they indicate 2 things, and it's a little bit hidden here. REO sales are typically the highest, and REO sales are still going, despite the fact that those properties are sometimes badly mangled properties, they're still going out at very close to list price and in multiple offer situations. And if you look at the equity sales, what that really says, that number doesn't account for equity sales that never sell. What you're seeing is that properly valued equity sales are selling, and they're selling at reasonably high price to sales to list price ratios. The problem is the ones that sit and sit and sit because they're overpriced. And so, again, I know you all know that. You look at the average number of offers, we're seeing a number of offers. We're also seeing that 30% rate, but we've got good market demand, all things being equal, and considering the underwriting. Just one other comment. Obviously, days on the MLS, 67 for an equity sale, 50 for an REO sale, 141 for a short sale. 141 is a good number. That number was over 230 days when I did this a year and a half ago. Okay, notice of defaults. Again, we've got a somewhat improving situation in California. Unlike most of the other states, we have non-judicial foreclosure. It's a fairly straightforward process, you would think. And it still creates difficulties, and certainly you've had issues around robo-signing. You also have a very litigious atmosphere in California, so I can certainly understand why lenders are concerned. But we're basically in a downtrend on notices of default. We're basically in a downtrend on foreclosure trustee deeds recorded in Southern California. You can see how it varies from the various counties. And if you look at outcomes here, what we're starting to see is that cancellations are still the issue. And we don't know what's behind cancellations. A lot of that deals with the bureaucracy of a loan modification, with all that nonsense. But we are starting to see the REO trend downward. So let's look at Manhattan Beach for a second. Manhattan Beach, you can see exactly the pre-foreclosures, the auctions. Pre-foreclosures are 16, going to auction are 22. Bank owned, there's 3 REOs. We ran this number on the 2nd of February, so less than a week ago. There are 3 REOs at the moment in Manhattan Beach. If you look, by the way, this looks like virtually no other place in California, just in case you're confused. And it really doesn't look like any other place in California. It's beautiful, and people will do anything they can, obviously, not to go to foreclosure. And generally, the activity buildup is so much more rapid that they don't have to. But this is an unusual situation. If you're not using one of these tools, by the way, to farm, you should be. And I'm sure you guys are. So. This happens to be foreclosure radar that we're using. Hermosa Beach, a little more activity there in terms of bank owned. Probably, given the size of Hermosa Beach, 10 REOs in Hermosa Beach is on the high end. I mean, it does represent some opportunities there that will have some impact on prices. Redondo, this is starting to look more normal to me. Where you've got a lot of things going on, although even here the REO is very, very low on a demographic basis. So. There are still, if you look at those pre-foreclosure numbers, there's still a lot of foreclosures that have to get through the pipeline. This is the shadow inventory on a local level. But, the impact here, you can see it in terms of the sales. Sales are definitely, we're slower here in Manhattan Beach not here, but in your market area north of here. We're slower over the course of the last couple of months here. But if you look at these are numbers by month. 2011 was not a bad year. It was not a bad year at all. There's a lot of seasonality in these numbers. The January numbers are decidedly lower, but still, given the pricing, average pricing, you're one of the most unique markets, one of the strongest markets to have been for the downturn. If you look at the median price, your median prices, in Manhattan Beach is holding up surprisingly well. Obviously, you've got a very small base here, so one really large sale impacts the price, but prices are holding up well. The inventory levels, they're somewhat high. For Manhattan Beach normally has an inventory that runs below the state average considerably, and it's not doing that, but it's still, 4% every 4 months. I used to tell realtors that if you were below 4 months, it was a seller's market. If you were above 9 months, it was a buyer's market. If you were between 4 and 9 months, it's a realtor's market. And I still believe that because I think what you do makes a huge difference in terms of your ability to make a sale happen. Hermosa, again, very similar picture. This is the price. Prices are holding up reasonably well in this area, considering the median prices. They're holding up extraordinarily well. And you look at the inventory here, and the inventory is a bit higher, but still an inventory for a high-priced area. We talked about median price. Your median price is roughly $900,000, and you've got a 5.8 months inventory, whereas the state $1 million plus is almost 9 months. So you're doing well in these marketplaces. I know it's tough, but you are doing well in these marketplaces. Redondo, this looks more normal. You got more units being sold here. Again, you're still not talking about a lot of units when we break it down by month, and there's just too much fluctuation here. But the Redondo market is a little more reflective of the state as a whole. But 5.3 months, again, given your median price, is a pretty normal marketplace. So, to sum up, if I can, I think I've got a couple minutes long. I do think that the market is recovering. I think it's recovering slowly. I don't think it's going to turn overnight. I think there's a lot of, a lot of risks on the one hand, but I also think there's some upside. Things do become self-sustaining at some point. As I said before, I think it's a critical time in terms of housing policy, and the housing policy, from my standpoint, that needs to be reinforced is one that focuses on home ownership. Normally, if I had time, I'd show you some slides. And even though this is a rental market, and a rental psychology that's emerged, if you really question people, and especially if you question people who are recent immigrants, they think homeownership is absolutely central to the American dream. And from that standpoint, and the fact that affordability has never been better, given the risk to the 30-year mortgage in the future, I think it's an incredible time to buy. Let me conclude by saying again what I already said. Speaking for myself personally and my family, every good deal I've ever made in real estate, I made because some realtor forced me to make it. I had all these reasons why I shouldn't. And the realtor convinced me, and frankly, every one of those turned out okay. I've done some really dumb ones on my own, but again, I think this is a market where you make all the difference. This is an incredibly productive firm, and again, I wish you best of luck. We'll make the slides available, and thank you again for having me.
Okay, that's known as drinking out of a fire hose, and we continue. And now what I noticed up here is Mark and Barry are paying close attention to what these other gentlemen are saying, and so I'm getting a lot out of it. Barry, would you like to tell us what you think about the national and the local and perhaps the euro?
We'll definitely talk a little bit about that. So some really good information, certainly, and it is like drinking out of a fire hose. And on that theme, knowledge is something I think that's really critical. Look, this is 2012 and information is everywhere. But knowledge is a very valuable commodity. I think that's why it's important to be in gatherings like this, because the knowledge that you gain and share with your customers really makes a difference. In my opinion, your customers will pay for that knowledge. And the way that they pay for that knowledge is by giving you their business, giving you referrals, and being loyal to you. So I've got quite a few things here to go over, so I'm going to try and go quickly. So if you can, put your mental roller skates on. We're going to, why don't you just put that down for a second? I'll if you want to just reduce that or turn that off for a minute. So I'll tell you when we're ready to rock with that. So let's start with rates. So we're going to talk about rates, we're going to talk about the euro, we're going to talk about housing. I've got an idea for housing, and I've got a couple of tips along the way. So here we go. So rates. Rates right now, truly at historical lows. I know that you hear that, but they really aren't. They're at historical lows. And this presents a wonderful opportunity. Now, what's the forecast for interest rates? Well, if we go by the Fed, it's very different than mortgage rates. And yeah, the Fed's saying that rates will be low till the end of 2014 instead of the middle of 2013. When they said that originally on August 9th, I thought that was such a big mistake. And the recent comments that interest rates will be low through the end of 2014 is, I think, just foolish. Foolish for many reasons. Remember that these are academics. These people never did as much as run a candy store, had a paper route in their lifetime. So they don't have any understanding as far as business goes. They don't have any understanding as far as human psyche goes. Because if they did, they would understand the absolute worst thing you could do is say that rates are going to be low for 2 years plus, okay? Why is that so foolish? Why is that so flat out stupid? Because A, mortgage rates are not predicated on Fed funds rates. B, just because you say that you think rates are going to be low or you anticipate them to be low, it doesn't guarantee them to be low. The Fed has been wrong, significantly wrong before. They thought that the 09 rate of unemployment would be 4.8%, it was 10.2%. They thought that the subprime crisis will be contained. They said that in May of 07, just 2 months before the greatest financial crisis hit the planet, okay? So just because the Fed says something doesn't mean it's a guarantee. But the thing of it is that here's what your customer hears. Your customer just heard, oh my goodness, mortgage rates will be low until the end of 2014, so therefore, I'm not in any rush to buy a home. I can take my time. And in essence, it's the greatest buying opportunity in the history of real estate. Because that's what I think it is. I'm going to give you evidence to support that in a minute. And I want you to share this with your customers. See, if you have the Fed doing this, they fail to miss the point of human nature. Because we don't do things in advance. We procrastinate. The majority of us do. Those of you who have been around refinances or a lot of sales, when does that start happening? As rates are going down? No. When rates are at their bottom? No. When does it happen? All the activity happens when rates are going up. It's because everybody says, oh my gosh, I don't want to miss the boat, the train's leaving, I've got to get on, right? So by the Fed saying this, they've actually hurt the housing market. And that's why it's up to us to share that knowledge and to communicate correctly what the real deal is. The Fed funds rate has nothing to do with mortgage rates. Mortgage rates are based on mortgage-backed securities. Now, they're somewhat akin to treasuries and longer-term treasury maturities because there's a competitive environment there. But there are many things that can influence that. The Fed said they're going to tolerate more inflation, and inflation is the enemy of interest rates. Higher inflation, the higher rates of return that you need. So it's my opinion that rates will move up more quickly than people think. In fact, I think the housing market will get to higher levels more quickly than people think. You see, there's an old saying, is that for an event to take place, it takes far longer than you may have thought. But the transition of when it happens far more quickly than you would have ever imagined. And that's what's going to happen with real estate. The decline happened exactly that way. People started forecasting the demise of real estate for many years, and it took forever for it to happen. But when it happened like that. Any stock market occurrence happens exactly this way, whether the move is higher or lower. Look, just a short 2 years and 10 months ago, the stock market was unbelievably out of favor. Who in their right mind wanted to get involved in the stock market? And in 2 years and 10 months, stock prices have more than doubled. The right time to be a buyer is when it's out of favor. Real estate is still out of favor. Let's talk about where interest rates are headed. Interest rates over the long term clearly are going to be headed higher, but over the short term we're going to have an opportunity where interest rates should decline. That opportunity may come within the first few months of this year. You may see an all-time bottom then. What's the reason for that? The reason for that is there is an imminent crisis in Europe. Greek debt will be defaulted upon. It's not a question of if, it's just a question of when. This is a game that they're playing. Greeks do not pay taxes very well. There are 6, get this, it's a country of 11 million plus people. How many people claim over 11 million euros? How about if I told you 6? No, not 6%, not 600,000, not 6,000, not 600, 6. So the Greek government sends planes over people's houses to see who's putting in swimming pools. And when this deal comes up, whether it be today, tomorrow, the day after, and these austerity measures are brought to the Greek people, they will riot, and it will become a disconcerting event. Now, Greece will potentially be excluded from the euro, because the euro was created with very good intentions. And when this was done, these countries in the north, think Germany, had difficult times competing with the countries in the southern and Mediterranean parts of Europe, because they were oftentimes prone to devaluing their currency and made their exports a lot easier for people like us in the United States to purchase. Well, this was a big incentive for countries like Germany to do this and create one currency so they couldn't be outbid. Countries in the South said, hey, we should do this because we'll have access to credit like never before, lower rates than never before. So it seemed like a good marriage. But as countries in the South used that credit to overextend themselves, they're now in a position where they've kicked the can down the road so far, and they can't recover from it. So what do? These haircuts trigger other events. They have to be deemed as voluntary haircuts because if they're not voluntary haircuts, the insurance has to kick in because then it's considered a default. And that means that other countries can claim that insurance, and insurance companies and banks do not have the ability to pay that. Banks in Europe are